So, g'day all. Dane Jansen here from Positive Dynamics. I hope everybody's well. Look, we just wanted to have a bit of a chat today and run this bit of a session. We're getting a lot of questions in the market still with regards to what's going on with the conflict and those sorts of things, and what impact that has on markets. So look, we've done a lot of research, as we always do, around what that looks like, but also I just wanted to go through what that has looked like in history and what we can take from history to give us a bit more confidence and peace of mind for today and moving forward. So look, I'll flick over the presentation. We'll get started and go through what we're seeing. G'day, Richard. Thanks for joining us, mate. Look, I was just saying, we'll get started. So just wanted to have a chat today. I'll flick over to my presentation, but the whole concept that we wanted to run through today is, market crashes per se. What that looks like in times of war and conflict, and what impact that has on financial markets. So just a bit of a general advice warning. Anything that we talk about today that I cover off on is just general in nature. So there's no personalised advice, but we'll keep rolling on. Look, what we're seeing is, so there's a saying out there that says history doesn't repeat itself, but it does rhyme, and that's definitely what we're seeing today with regards to conflicts around the world. What we're seeing come out of the back of the pandemic, and just wanted to go through, what happens in these sort of situations where you get these geopolitical sell-offs. How long they last for, and what that history can teach us. All right, so a bit about myself. Dane Jansen, co-founder of Positive Dynamics with Vanessa. I'm director and the investment committee, and also the compliance committee here at Positive Dynamics. So I've been doing this for a long time now and love it, and love helping you guys out and give you plenty of information. Okay, so getting to the crux of it. So geopolitical sell-offs and what they look like. Okay, so in times of crisis, whether that be war, pandemics, whatever that may look like, there is always a world impact to investment markets. And look, this is just a quick slide put together by Vanguard, just showing what that recovery time can look like. So this is the earliest. The earliest date on this slide here is 1962, sorry, Cuban Missile Crisis. So look, if you have a look at the left-hand side of the screen, the little key indicator down there, it's got the yellow bar, which is the initial sell-off, and then the length of that sell-off may vary, but the initial sell-off with regards to a conflict. The light green line in the middle is that 6-month recovery, what looks like 6 months after that conflict has started. And then the darker green line on the right-hand side is 12 months after the conflict has started. So look, we'll start with that, Cuban Missile Crisis in 1962. So initial sell-off was down 5%. So took a hit straight away, very quickly, but within 6 months thereafter, the recovery was very quick as well. This is what we've sort of been considering will happen here in this Ukraine crisis. So in the Cuban Missile Crisis, we were up 21% in that first 6 months after the conflict started, and then 12 months after, 26%. The market really did recover quickly and steeply. So we do get this as a common occurrence. So out of the eight geopolitical events that this slide notifies, there's only one that had a longer lasting impact, or more of a negative impact. And there was a few extra things involved in that. There was a lot more economic issues that come out of the back of the Watergate scandals and those sort of things. Hence the reason that in 1974 the correction was a lot longer lasting. Right. we can continue on to, look, the Soviet invasion of Afghanistan in 1979. And that was again a -5%, then a quick recovery to 6%. But then, within that 12-month period, we're up to 26% again. Now, first Iraq War in 2003, very similar. But the one that I'd like to point out is the Ukraine conflict in 2014. This is when Russia had invaded Ukraine again, but into that Crimea region, where they invaded and annexed Crimea into the Russian Russian body. So again, it wasn't as big an impact to the world at the time, but it was still, there's a -1% sell-off initially. Then within 6 months, we were up 8%. And then within that 12-month period, we're up 12%. So look, you do get quick recoveries out of the back of these things. All right, just wanted to flick over to the next page. This graph here actually shows, as I said at the start of the presentation, history doesn't repeat itself, but it rhymes. And this is a really, really good narrative for that, showing how history does rhyme with today. So we've just faced COVID in the past couple of years, global pandemic. We've rolled out of the back of COVID, now into a conflict in that European region with Russia and Ukraine. World War I and the Spanish flu. So World War I came first in 1914, but then right at the end of World War I, then the world was smacked with the Spanish flu. So again, we've had it in reverse. So we've had the pandemic first, then into war. World War I, or in that early 1900s, they had it war first and then into the pandemic. But as you can see, with regards to World War I, so over here in 1914, the initial sell-off happened quite quickly when we went to war. But then very soon after, and this is quite apparent, I don't have those exact dates, but as you can indicate here, so 1914 to 1915, we've had this sell-off, but then within 6 months, you've got this correction, and then 12 months thereafter, it's really quite run away. Obviously, the following impact there of the Spanish flu, you had a big sell-off again, and then another correction. Okay, so this chart here shows how volatile the markets can be. And again, this is the S&P 500. So this is the United States index. This isn't the ASX. The United States index, S&P, a lot longer stock market. So really, really easy to gain a lot of data from the index and that S&P 500. But as you can see, it looks very, very volatile. And obviously has been, and if you're living through these times as we are currently, the market is volatile, up and down, and it gives everybody that that drop, that your heart drops into your stomach where you go, oh my gosh, the market's correcting again. But I'll just flick to this next slide. Okay, so this shows that period of between 1914 and thereafter, that sort of 15-year period leading up to the Great Depression and what that looked like. But over that longer time scale, that volatility looks a lot smoother. So just something to keep in mind, we're all looking at long-term investing. Yes, we do have to try and consider these short-term aspects, but as long as we're in it for that long term, we don't panic. And that's what we're here for at Positive Dynamics, to help answer questions and those sorts of things, so that we don't get into a panicky situation and sell our assets when we shouldn't be. You'll enjoy that longer ride where you do receive those great returns over the long term. But as I said, this is the S&P 500 during the Great Depression. So they had this amazing run up after the war, after the pandemic. And this is where inflation was getting out of control, and again, another big correction into that Great Depression. All right, let's talk about World War II and what that looked like with correction. So again, we can learn a lot from history and what that looks like with what we're dealing with today. Okay, so this is World War II. Started in 1932 and ran through to 1945. Pretty big war. But you did have that period of the initial sell-off here at the start in 1939. An initial sell-off as the war started, but then another quick correction. In this instance, a big war. It did trail off over the next few years, but then from the bottom in 1942, we had this massive run up where you had this amazing growth again. So these things, as history shows, as long as we hold in there and we don't sell assets at these bottoms of the markets, you get amazing recoveries, and these are great opportunities. When we do have some surplus income laying around, or some cash savings, bottoms of markets are fantastic times, obviously, to try and get some money in there and gain that extra growth. However, we can't time bottoms of markets. We're at this position at the moment where we've had a correction, and that's looking at around about 13% at the moment in the S&P 500. Whether that has further to go, no one's sure. But statistically speaking, we should start to flatten out and get a bit of a recovery in the near future. There is a lot of things out there at the moment that are uncertain. Inflation in the US, interest rates, those sorts of things. So there is a lot of uncertainty out there, but again, as long as we hold in there for the long term, we get great recoveries. Look, this one here is just that zoomed out aspect of 10 years after World War II started. So again, started here in 1939. We had that sell-off, but what an amazing recovery that we had until the end of the 1940s, where we just had that massive peak. The markets had gone crazy, huge bull market. So it's one of those things, again, if we hold on, we can have some great times coming out of the back of these conflicts. And as much as there is concerns and hideous humanitarian outcomes from investment markets perspective, they will always recover. Look, just wanted to finish off on a couple of things. This is our advisory team here at Positive Dynamics, which I'm sure you guys all know. And if anyone ever has any further questions off the back of either presentations or market in general, just wanted to understand what happens in these situations, please feel free to reach out to your advisor. Plenty happy and friendly faces here to answer questions. And on the other side of that, if you have any friends or family that have concerns about this time in the market, with what they're doing, with what their portfolios look like, details, and get them to reach out. We're more than happy to have a chat and help where we can. All right, guys, hope that has given everybody some insight and hopefully some clarity and confidence at where we're up to in the markets and what they look like at the moment. If anyone has any questions, please jot them into the chat box. I hope people have been doing that along the way. And I'll try and answer questions where I can. Thank you, guys. I don't quite know where these questions may have popped up. Give me a second. Okay, here we go. Okay, well, we haven't got any questions popped up. Richard, have you got any questions, mate? Hopefully I've covered off clearly enough content. Yeah, absolutely, Richard. Now would be a great time to consider investing. Really good, good question. Yeah, it's one of those things. You can never time the bottom of the market, but it's not always the biggest concern to try and time that very bottom. At this point in time, investing into good quality assets, you're buying them at a really good rate anyway. That you get that discounted rate approach if you're buying them. As I said, I think the calculation works out to be about 13.5% that the S&P 500 is down currently. So that's you're already in that position of a really good advantage of taking a 13.5% discount from where the market was. And I only was reading an article yesterday that there's some investors that are expecting by the end of 2022, if everything goes as the research was showing, there's an expectation that the ASX 200 potentially could get back up towards that 8,000 mark. So look, there is always opportunities out there, and yeah, it's definitely a time to be getting money into the market where you can. Thanks, Nat, for that question that came through. With regards to fixed interest is a hard one at the moment. Obviously, with inflation being so crazy over in the US, the government has obviously dumped a whole lot of money into the market, reduced interest rates down to the point where any of those longer term yield bonds, fixed interests, they haven't been providing any real return, any real yield. We've got an inflation rate in the US, and I keep speaking about the US because being the biggest economy at the moment, they tend to drive a lot of things. So their inflation at the moment is 7.9%. It was on Friday last week when they announced. So let's call it 8%. With yields coming out of bonds and fixed interest that are in the ones and twos, you're in a tight position. So to be able to try and find extra income, you do have to look at taking those extra bit of risk into different credit options, shorter term or private credit type situations where you can pick up a higher interest or a higher yield. But again, it's taking extra risk. So, you do have those opportunities, particularly now, where you can use your equities and buy shares which are high dividend yielding, which will provide a better income and a better return. But overall, from a protection perspective, your cash and your fixed interest are still there to hold that big crash. And obviously, on the other side of that, we like to use some precious metals to hold that as a hedge against those market corrections and times like we're in at the moment. So again, I hope that answers the question. Sorry, I couldn't be more specific about fixed interest. It is a tough space at the moment. So. Okay, so what are expectations around interest rate hikes between now and Christmas? Do you believe that owing to the war, which has led to a higher energy and fuel price, interest rate hikes will be delayed? Okay, it's a great question. I personally think that they will hold interest rates and delay those hikes. All the research was showing up until a month ago, we were going to start seeing interest rate hikes this month. The US has come out and said that they would start to hike interest rates in March, and this would be what they'd be looking to do. I think that their interest rate announcement comes out the 16th, so today, but tomorrow for us, today in the US on the 16th. So we'll find that out tomorrow what they decide to do. But I think that, as you said, given the price of oil and fuel has gone up so much, that's going to have a massive impact on families and households, more so than a 0.25% interest rate rise would do for a mortgage. At the moment, with the price of fuel that's gone up, well, quick calculations that I did the other day, was 33% the price of fuel had gone up. That was in the US and also here, and also in Europe. So it was about 33%, give or take, a couple of points. But whether that be gallons, in the US, I think they're up to around about $5 per gallon. Here we're at $2 odd per litre. Europe is the same. And from what that looked like around about 2 or 3 weeks ago, it's about 33% increase. So that's significantly bigger increase than the interest rate rise would have been, obviously. But from an impact to putting fuel in the car, quick calculation was around about $50 or $60 per week for a lot of families to go into each car. So that's a big impact to families. A bigger impact than that probably would have been to their mortgage, with interest rates pushing up. So I really do think that in this time, if the reserve banks decide to put their interest rates up, it will definitely have a adverse effect to what the world looks like currently. I think that though the concept is we need to slow inflation, which is 100% true, I actually think the knock-on effect of this fuel price and interest rates at the same time would be pushing particularly the US into a recession. So I think that will probably hold for at least another month. That's just my personal opinion. G'day, Terry. How are you? All right. But no more questions coming in. How am I running for time? All right, if that answers all questions, I think we might finish it there. Terry, I know that you've just popped in. We have recorded this whole session, so I'd love to send it through to you. And then if you've got any questions off the back of it, I'd love to have a chat over the phone or send through an email. That'd be fantastic. Apart from that, I thank you all for your time, and I will see you all next time. Thanks again, Dane Jansen, Positive Dynamics.